Greetings, everyone. I'm David Darst. We hope you're having a good start to June. The first week of June in the U.S. equity markets for liquidity, stocks, bonds. You had the Standard & Poor's down 1.2% last week. It's now down 13.8% year to date. And of course, NASDAQ is down almost double that. NASDAQ Composite Index is down 23.2%. Let's run down each day of last week. It was a short week because you had Monday, the Memorial Day holiday in the United States. Tuesday, you had the Case-Shiller Home Price Index, which came in above 20%. That's 2 months in a row, 20% year-over-year increase in the National Home Price Index. Secondly, you had the ISM Manufacturing Index came in stronger than expected at 56.1. Anything above 50 is expansion. Below 50 is contraction, and that compares to 55.4. The Fed is looking basically to moderate growth, but the markets basically interpreted that as that with the economy this strong, the Fed's got to step up its restrictive actions and rhetoric. Jamie Dimon, the CEO of J.P. Morgan, as he mentioned last week, that he's expecting a hurricane coming down the road. He doesn't know whether it's a superstorm Sandy, which would be a huge hurricane, or a modest-sized hurricane, but he says you've got to buckle up and be prepared. So that led the stock market on Tuesday to be down 0.6%, the Standard & Poor's 500. Wednesday, it was down 0.7%. You had the FactSet, which is the earnings, came out with their earnings forecast. The first quarter, year over year for the S&P 500, up 9.2%. That's what it's working out to be. Second quarter is supposed to be, that's the quarter we're in now, much slower, 4.2%. Third quarter, 10.3%. Fourth quarter, 9.9%. The full year, 2022, is expected to be 10.2%. Now, the stock market, the S&P 500 closed at 4108 on Friday. If you accept the current earnings estimate of $240 for the S&P 500 companies altogether, aggregate, that would mean the S&P 500 is trading 4108 divided by 240 is 17.1 based on forward price earnings ratio. The long-term average is something around 15 or 16, so it's come down from above 20. That's one thing, but it is still above average, and there's nothing that says it can't go below average. Thursday, you had a huge move up in the market, up 1.8% for the S&P 500. Why? You had the automatic data processing, ADP, which is a payroll processor. Private sector payrolls expanded last week, only 128,000 jobs. That is considered to be slow, and that means they might ease off on their restrictive monetary policies in September. We already know we've got a June 14th and 15th Federal Open Market Committee meeting coming up next week, not this week, next week. People are expecting 50 basis point increase. They had a 50 basis point increase at the most recent meeting. Then July is expected to be another 50 basis point increase. There's no meeting in August. They take the month off. And then that would mean if they're going to have any more increases after that, 25 or 50, it would be in September. People interpreted the kind of soft payroll numbers of ADP positively. You also had the OPEC announcement after their meeting of 648,000 barrels per day incremental. It'll primarily be supplied by Saudi Arabia, United Arab Emirates, but the market saw this as a positive. This makes up somewhat for the anywhere from 700,000 to 1 million barrels a day of Russian oil production that has been not supplied to the market because of sanctions and other difficulties. Then on Friday, so they had the market up Thursday. That was the only day it was up last week. On Friday, it was down 1.6% because of a decently strong, not super strong, but decently strong jobs report. 390,000 jobs. The previous 2 months were revised downward by 22,000 jobs. The unemployment rate came in at 3.6%. Average hourly earnings up 0.3% month over month and plus 5.2% year over year. The S&P now has rallied 10% from its lows of May the 20th. If you remember, the S&P 500 got down to around 3,800. It closed at 4108 on Friday. So it's rallied. Why? China is beginning to reopen. Secondly, there is some feeling that the Fed might dial back and not be so restrictive out in September, given certain softness that's beginning to appear in the economy. The third factor, which we've been highlighting, is, of course, the Russia-Ukraine conflict, and that is still open. So this week is going to be all about the inflation focus. The inflation focus. Friday will be the last meeting. There'll be a Consumer Price Index, the last issuance of the Consumer Price Index until the Fed meeting next Tuesday, Wednesday. Right now, the estimate for a headline is for the headline to be up 0.9% month over month and 8.5% year over year. So that's going to be pretty high. Stay tuned. Watch for that. You also want to watch the distance between the 10-year and the 2-year Treasury interest rate. It's currently about 30 basis points. 296 for the 10-year, 2.96%, 2.66 for the 2-year. That's 30 basis points. If that begins to get bigger, that's considered to be a growth outlook. If it gets smaller, that's a recession outlook. With that, I wish you a great start to the month of June and look forward to catching up soon.